This is such a predicament of serious research. The latest issue of the Dispatch report is just out. The report is titled 2026 Rough and Tumble Times, Overheating Industrials to Rattle Market. Let's get into it. Basically, the report outlines why we've got a more defensive stance. This diagram basically walks through this idea of a buyer beware moment. The logic here is that critical tactical indicators have now reached some overheating point. Number one, risk appetites are well above normal. And number two, markets are especially crowded. In fact, what is changing is that we're now seeing hints of that in the industrial sector. We'll talk a little bit about that as well. In terms of how we're positioning in terms of the portfolios we're running, on the growth side, we run three different growth blends: aggressive growth, GARP, quality growth. If we're right about this sort of tactical challenge, the idea is to lower the trending factors. And then if that's the case on the growth front, both the GARP models and the quality growth blends will probably outperform. The quality growth blends we lean a little bit towards because we're also seeing sort of a softening in economic growth that tends to focus more on earnings visibility if you're in that kind of environment. Similarly, for the value bias in terms of deep value, if the economy is slowing, you do not want a deep cyclical value portfolio. You want to move more towards a relative value or quality value. So in terms of how we're positioned for markets, this idea of the tactical overhang that's there, the idea that there is a bit of a softening, the reality is that maybe you've got a Fed relief, maybe not. Those are the things that are sort of like the offsets. Bottom line, a rough and tumble year. In terms of risk appetite, this chart relays the CRX indicator. Bottom line is that the readings have spiked to unusual levels this past few months. In fact, the levels that we reach are now higher than what we saw in the 99-2000 peak. At the end of the day, when these models are spiked to such level, they're a wonderful contra signal. Bottom line is trending factors tend to break down. In addition to that, the crowding model, as you all know, the US markets have been very much an AI-driven marketplace. What this underscores, though, is that you're now creeping into some very unusual territory where this sort of like focus on just a few names, those are things that suggest that you're likely to have more volatile market. Trending factors break, quality factors, value factors tend to outperform. In addition to that, when we look at the asset allocation model, if you were to take the broader sampling of variables besides the tactical measures, such as valuation, interest rates, etc., these are things that are forcing the equity allocation to a much lower level, levels that we haven't seen in 2-3 years. We're now severely underweight equities, and this is something that that'll force the equity fund manager to play more defense in this environment. What are the sort of pivotal elements in terms of how to, let's say, carve out the risk in the portfolios? At the first level, we can talk about factors, and secondly, we can talk about sectors a bit. But at the factor level, high beta has been so dominant in terms of the run-up that we've seen, notably in the larger cap camp. Our idea here is to sort of temper the beta in the portfolio because beta is something that's been very much well aligned with the AI run. In fact, better so than relative strength models, which has historically been the place to sort of set off or offset the trending risk. And then part two, what we've noticed is another sort of potential fissure that's opening, this time in the smaller cap arena with industrials. What we've seen in the last year is a massive run up in micro cap industrials and small cap industrials. In fact, I think this sector has been potentially single-handedly responsible for why smaller stocks have been back online. When we dig into this a little further, what we'll also notice is the valuation levels for the smaller industrials are now climbing well above the ranges compared to the larger cap industrials. And this is stunning, but does relate how dramatic the small cap industrials have run. In addition to that, what we're also noticing is the CapEx spending data for industrials are starting to slow. What we're also seeing, though, is that the forward estimates are starting to roll off a bit, whether it's large or small caps. So this is something that we're going to have to pay attention to. Take a look at the full report, and as always, happy to take your feedback. Thank you.